Welcome to the Deep Dive. Today we're taking a scalpel to the Q3 2025 earnings conference call for Intrusion Inc.
Yeah, our mission here is to go way beyond just the press release numbers. We're going to distill the key financials and, more importantly, really try to extract what management's strategic bets are.
Right, to give you the high-level insight needed to understand exactly where this cybersecurity firm is placing its bets for future growth.
We're going to focus on a few key things. First, the shift in their revenue mix. Second, the early signs from their cloud expansion.
And of course, the big one, the substantial but pretty complex opportunity in critical infrastructure protection.
So let's just jump right into the results snapshot. The headline number that the market's looking for is momentum. And Intrusion delivered its sixth consecutive quarter of sequential top-line growth.
Which is, that consistency is a key indicator, isn't it?
It absolutely is. Total revenue came in at $2 million. That's a 5% sequential increase and a really robust 31% increase year over year.
And that suggests a real increase in demand, supported by something you pointed out before we started, near zero customer churn.
Exactly. Once they get a customer, that customer stays. It speaks to the stickiness of the product.
Okay, what about margins? Gross profit margin held steady at 77%.
Very healthy. It did dip just a little bit year over year, but management said that was expected. Just variability based on the product and service mix for the quarter.
But I have to stop you there. 77% is great, but the company still had a net loss of $2.1 million. That's consistent with the prior year.
And that's the tension point, you're right. While sales grew, operating expenses also climbed to $3.6 million.
Which was driven by what?
Strategic investments, sales, marketing, trade shows, brand awareness, and some higher share-based compensation from earlier equity grants. They're spending money to make money, essentially.
Okay, let's unpack that revenue. Because the story here is still so heavily dependent on specific contracts. Where did that $2 million actually come from?
Well, the growth was largely driven by expanding their contract with the U.S. Department of Defense, the DoD. They're using both the SHIELD technology and Intrusion's consulting services.
So it's still very government heavy.
Oh, absolutely. The consulting revenue accounted for $1.5 million of that $2 million. That was up about $100,000 sequentially.
And the SHIELD product revenues?
That was the other $500,000. Pretty flat quarter over quarter, but it was up $100,000 year over year. And management's whole plan is to, really shift that mix more toward SHIELD and more toward the commercial sector over time.
Speaking of those big government contracts, liquidity is always the big question for a growth stage company. What's the balance sheet look like?
This is where things get really interesting. On September 30th, they had $4.5 million in cash and short-term investments.
Okay, not a huge runway.
Right. But crucially, after the quarter ended, they received $3 million related to that DoD contract extension.
So that pushes their total liquidity up to $7.5 million.
Correct. And management believes that's enough to fund operations through the rest of 2025 and into early 2026. That DoD funding is a significant buffer.
It de-risks things. It means they aren't forced into, say, an unfavorable equity raise just to keep the lights on.
Exactly. It lets them focus on executing the growth strategy.
All right, let's pivot to that strategy. Management highlighted 3 big growth vectors: cloud, critical infrastructure, and partners. Let's start with SHIELD Cloud.
So SHIELD Cloud is, it's really about placing their cybersecurity engine where all the innovation is happening.
Right.
In the cloud.
Right.
They launched on the AWS Marketplace during the quarter, and management is already seeing traction. They expect a positive financial contribution starting as soon as Q4.
And they're not just stopping at AWS, are they?
No, not at all. They're already prepping for a launch on Microsoft's Azure platform that's slated for later this quarter, or maybe early Q1 2026.
And they learned something from that AWS launch, I understand.
They did. This is the key technical detail. They created a standalone version of SHIELD. It's not coupled with the pfSense open source firewall anymore.
And why is that so important for our listeners who follow the tech side?
It's all about the addressable market. Big enterprise customers, they already have their own firewalls. Cisco, Palo Alto, whatever. They're not going to rip that out.
So by decoupling, SHIELD can now just plug into any existing security setup.
Precisely. It broadens the customer base massively. It turns it from a niche appliance into something that can augment any high security environment.
Makes sense. Okay, next up was the Port Nexus partnership, focusing on education and law enforcement. What's the deal there?
So this is about endpoints. They have a solution called MyFlare. And the thing that stood out to the CEO was the sales cycle. He said it's one of the shortest they have ever seen.
Really? Why so short?
Because the demand, especially from school districts, is just incredibly urgent. They need enhanced security and situational awareness during, the critical first minutes of an incident.
So the urgency just cuts through all the usual procurement red tape.
Exactly. And the company sees this as a model for how they can expand into other endpoint security partnerships. Quick wins.
Which brings us to the potential blockbuster. Not a quick win, but a big one. Critical infrastructure. The OT Defender.
Now we're talking about the big dollar sales. Management shipped over 230 of these units to the DoD as part of that contract we mentioned, and now they're actively pursuing more deals across government and the private sector.
So why is this a bigger deal than cloud or these partner initiatives?
I mean, if you connect the dots, management sees the operational technology or OT environment as the single biggest area of underinvestment in cybersecurity, period.
We're talking about power grids, water systems.
Yes,
Right.
the systems that control the physical world. A lot of this gear is old, it was never designed to be connected to a network, and it's incredibly vulnerable. It's a prime target for nation-state actors.
So the sales here are much larger.
Much larger. They tend to be $100,000, $200,000 and up. A single deal there can have a much more meaningful impact on revenue than, a dozen smaller SaaS deals.
This does raise a question about risk, though. They mentioned the government shutdown on the call. That has to impact momentum, right? Especially with the DoD.
You'd think so. But management said they hadn't seen any meaningful effect yet. And while they think a resolution will open up even more government work, they really stressed that their pipeline of non-government opportunities is expanding.
So they're mitigating that political risk.
They're trying to. The private sector OT space utilities manufacturing is growing fast for them.
Okay, let's look long term. Management says they're committed to growth, but they're not satisfied. What signals are they sending about their strategic position?
Two things came up in the Q&A that investors really need to pay attention to.
Okay.
First, the CEO made an incredibly bold statement. He said that the company's intellectual property, their IP alone, could be worth multiples of the current stock price.
That is a huge claim to make on an earnings call. What would have to happen to even begin to justify that?
Well, you'd have to see the cloud strategy really work with non-DoD clients. You'd need to see them close a string of those big private sector OT deals. And you'd have to believe their tech is genuinely unique. He's betting it is.
And a second signal.
It's related. They confirmed their products could integrate really well with a larger cybersecurity company's suite of tools.
A clear M&A signal.
As clear as you can get. They're basically saying, we are ready to be acquired. We can be a bolt-on that adds immense value to a bigger player.
And they also clarified their announcement threshold for deals.
Right. They'll generally announce contracts of $100,000 or more.
Yeah.
But, and this is key, they're sometimes contractually forbidden from announcing deals, even big ones.
So we could see a surprise revenue beat in Q4 or Q1 from a deal that was never publicly announced.
That's the implication. All right, let's put on our hedge fund analyst hats.
Yeah.
It's time for our This Is Not Financial Advice segment.
Let's hear it.
Given Intrusion's proven traction with the DoD, that liquidity buffer, and the CEO's commentary on the value of their IP, the thesis here is pretty simple.
Which is what?
Critical infrastructure security is too vulnerable, and their OT Defender product is poised for a major breakout, either on its own or through an acquisition.
So pitch the trade. The outrageous but plausible trade idea.
Okay, we're calling it the Critical Infra M&A Pop Trade. The idea is that Intrusion is trading purely on its current small financials. The market is completely overlooking the strategic value of its OT Defender system.
And its access to the DoD.
And its access. The bet is that a major defense tech contractor or a big cybersecurity player realizes it's cheaper and faster to just buy Intrusion's proven OT IP than to try and build it from scratch.
So you're betting on the CEO's conviction.
You're betting directly on the CEO's belief that the IP alone warrants a multi-bagger return and that the national urgency to protect critical infrastructure is going to force an M&A event in the next 12 months.
It's a high-leverage bet on a geopolitical catalyst, not just organic growth.
Exactly. And of course, just for discussion and analysis, this is not financial advice.
So let's sum it all up. What does this all mean?
Look, Intrusion is executing. You're seeing consistent top-line growth, you've got stable liquidity, and customers aren't leaving. The story now shifts from just surviving to proving they can scale.
Proving out that AWS and Azure cloud strategy, and more importantly, closing those big $100,000 plus deals in the OT sector.
Their confidence is sky high. You heard it from the CEO's own mouth. He believes that IP holds multi-bagger value. So the next few quarters are everything. It's all about how quickly they can turn that pipeline into real sustained revenue.
Right, and start to narrow that net loss and actually prove the valuation thesis.
So we'll leave you with this final thought to chew on. If the CEO is correct and the OT security market really is the biggest cybersecurity opportunity out there, is Intrusion better positioned to capture that value on its own over the next 5 years? Or should investors start calculating the floor for a strategic acquisition that could unlock that value overnight?
A great question to end on. Thank you for tuning into this deep dive.